Okay, there we go. We've started. It is December 28th. I'm Tim Quast, and this is the final 2023 live Edge demo and discussion. And thank you for being here. Hope it's been a good holiday season for you. Sure has for me. I took a few days off. It's beautiful here in Steamboat Springs. Conditions were kind of rugged about a week ago, and then we got 28 inches of snow this past weekend. It snowed for 4 days, it really made a difference on the mountain. I've been out skiing every day, and it's been just terrific. Don't tell anyone though. We don't want the mountain to fill up. So, okay, I've got hi Steve, good to see you. I got your email, and I appreciate your feedback too. And I'll share what we discuss in these demos stays here, except of course we record it. But Steve, I appreciate it. You pointed out, you mentioned some things that are frustrating with the platform, and I will have a discussion with the engineering team. I mean, we have a very difficult time replicating these problems because of the platform that we're using. But at root, those things are always about caching. And so and Azure, Microsoft has been jacking around with what's called their Kubernetes clusters, and they phase stuff out and they add stuff, and it's just vexing at times for us. But we will get that solved. And what Steve was talking about is, things don't load properly or don't display properly, and that's the bane of software as a service, and I loathe any sort of error. I mean, we do our darndest to make sure that we've got a stable, high functioning platform, but it's clearly we've had a couple of hiccups. So Steve, we will get to those things. That's the author of the Hicks rule there. The Hicks, which I used on Neo, by the way. And it was a 15-minute trade and a great 3% return today. I'll share that. Okay, so here's what we're going to do. At least this is my plan. I want to talk about some trading basics, talk about why, and Steve, you use them, but to me, technicals are not reliable. I can't use, and of course, I didn't grow up on technicals, but why don't they? I want to talk briefly about that, the relationship to ETFs. I want to re-emphasize entries and exits, and what we see statistically works very well. I'm going to show you some math, and then talk briefly about what's ahead. So that's the plan as I've jotted it down here. So let me share my screen. Frank, I see you're back. Thank you for returning. Okay, hope everything's well out west. Let's see here. Let me go over here. So the first thing, I want to just go to trading basics here really quickly. And what I mean by that is, how do you just proceed from the platform, you get to your dashboard, then what? And I'll use the momentum portfolio as an example. By the way, this has been a great time for momentum. Back up a week ago, there were 41 in this portfolio. We're down to 9. And there is not a statistical correlation between market direction and the number of components in the momentum portfolio. Clearly, it's been very easy. When there are 40 in there, I mean, anyone can trade and make money, right? It's when there aren't that it gets a lot harder. But we know that the choices are thinning. That's what it means. And I realize people on CNBC are talking about how the depth, the breadth of the market, it's broadening out, and that's a bullish sign. I don't think that reflects a good grasp of what the money is doing. I don't think that is the case. Look, I don't know what's going to happen next, but there are probabilities, and we can certainly see those probabilities. And I wouldn't think of it that way. And I'll explain in just a moment. But here's what you do. So right now, my point is, right now is a good time to trade momentum. So that's certainly what I've been doing. And why is it? Because broad sentiment is very strong and supply is insufficient, and it has been strong for a good while, and there have been plenty of choices here in this portfolio. What I like to do is I like to sort it by volatility. It doesn't mean I'm going to take the thing at the top of the list, but if I'm going to trade these, I might as well maximize my opportunity to produce a gain. And volatility, the way we define this is it's a 5-day average read of the amount of movement between the highest and lowest intraday prices. There are other terms maybe for that, for this metric, but we call it intraday volatility, or just simply volatility. And it reflects the way that machines set prices. You know, the most of the prices in the market is 100% electronic, 98% algorithmic. It is virtually all math. It isn't human beings who are making choices. And so the machines are going to do the same things we're doing. We're calculating, in effect, the probability of producing a return. Well, that's exactly what Citadel et al. are doing. They're going to calculate how much, and just mention, just mute yourself if you would. If you're, let me do this. I'll do it. Here we go. Chris, apologies. I'm just going to mute you. There we are. Okay. So back to the point. This is what the machines have determined they're willing to do. Well, we can take a piece of that. Machine set prices based on the rules, the regulations that measure, that govern how trades occur. And you know, they boil down to, I say there are two core rules in Regulation National Market System, which is thousands of pages. The original rule is 524 pages. And by the way, that's how we started. You know, backing up roughly 18 years ago, the first thing we did was read all the regulations and then say, okay, now let's step back and understand what that means to an order, and how do we create software that will measure conformity with those rules. That's the genesis of the platform. We are measuring conformity with rules because it's a heavily regulated market. And so when the machines determine that they will move coin 5.5%, they've already calculated the probabilities that can be done profitably. That's what they're doing. Wherever the supply demand, they're reading all the data. They consume all the proprietary data feeds that are much faster than the ones we see. You know, so if we go look at a price at out here, and this is real-time data, probably coming from IEX, is my guess. So those machines have faster data than that. You and I are getting what's called the SIP. This is the SIP, the Securities Information Processor. It is a system designed to give everybody access to, because that's a core tenet of Reg NMS. It is regulating quotes, trades, data, and access to all three. And so the SIP provides everybody access to price information. But the exchanges will sell proprietary data that are faster than that. So Citadel's going to know which way prices are going, even if it's only, you know, microseconds. They're going to know. And so you could see, you know, you might see this happen with SoFi. SoFi will sometimes have 10, 50, 300,000 shares at the bid or offer, and then it's gone, just vanishes. Well, how's that happen? Well, it's because the machines that are engaged in trading read the supply-demand challenges, orders coming into the market, boom, and they suddenly don't want to be on that side of the trade. And so all of those things, that's why that's not reliable. Technical signals are reflecting those sorts of things that are occurring that are unreliable. They don't reflect the real supply-demand balance. They reflect the machine's determination of whether to be at the bid or the offer or not. So it's interesting to see. By the way, the machines are starting to leave. If you look at the construction of the market and which behavior has dominated, they're starting to withdraw. That, again, doesn't mean they can't change. The data change all the time, but often that occurs when the market's about to change direction. Again, I don't know what's going to happen. We just watch the data. So so trading basics. This is why we do this. That's what I do. I'll go look at coin. I'll do this little drop down here to look at the chart. This is one of the things that sometimes hangs, particularly on the phone. On it, you know, if I use the mobile app. It's all the same. Oftentimes, because I might be trading while I'm on the gondola, as I did today. So if you're looking at the supply-demand balance, you know demand's very strong. Notice that the price move is when demand's strong and the supply trend is down, price tends to rise. That's what we're using. And the beautiful thing is we're just getting to see what everybody thinks. Demand is a reflection of every motivation. short-term, long-term, fundamental, technical, macro, global macro, model-driven. And notice that price gets wobbly if supply fluctuates. It didn't fall because demand remained very strong, but that's where the volatility increased in price. Where you had just demand, solid demand and falling supply, that was the best uptrend in price. We know those things to be true. I mean, that's the stuff we spend a lot of time vetting with probability data. Now, you know, is this awesome? Well, this is the Hicks rule is right when it gets to 10 and supply falls. There was no manifestation of the pure Hicks rule in this case. Gets to 10, supplies falls, very, very high probability of producing a return. But 10 and falling supply very consistently produces returns too. I'll show you some of the data, some that I did. I ran this for our engineering team so that they could go build models and test it across the whole data set so that we can calculate probabilities. But this is how they're better than technicals because they give you more time and less competition. We're not competing with fundamental investors. We're not competing with the machines, which we cannot beat. We're taking what they give us. And what they'll give us is some portion of 5.5%, sometimes all of it, sometimes less. I like to say I'm after 2. In momentum, 2% is really nice. Wash, rinse, and repeat. Oftentimes for me, trading is 2 minutes, 5, 10, 15 minutes a day. That's it. If I made my 2%, I close the app and I leave because I've achieved my objective. Why sit there? Might as well go do something else. I can come back tomorrow, try to repeat that. And if you do that every day, it's very successful. And there's pretty low stress. Doesn't work all the time. You have to be very careful about the data, no question. But that's what I'll do. So Chewy, I traded Chewy, and it's it was an illustration, and the data changed, right? If you backed up 2 days ago, it was out of the portfolio, came back yesterday because all the other metrics were there. Strong demand, falling supply. Is this as good as at other times? Maybe not, but it's, you can still trade that. I traded it here, and I bought it when it was down basically half of its volatility, about 3%, between 2.5 and 3. I don't try to be perfect about it. I just know, okay, well, it's down. It's down half of what the machines are willing to move that price. And then it didn't move for the rest of the day. I really didn't want to hang on to it, but it did. So sat on it overnight. The next day, what did it do? Went up 5%. Right, with 4.3% from my entry point. It was better than that. I did not capture all of that. I was talking to my neighbor and getting ready to ski, and I'm using my phone, and I said, "Excuse me, I have to execute this trade," and I left the position. I took off my limit, and it would have gone through my limit at 24.66. But the point is, how would we know? How would we know that it's going to do that? Well, because the math told us. We know it has the probability of moving 5%. It may not do that today, but over it, the consistent central tendency is that it will do that. And I know the demand is strong. Supply, while it's a little above trend here, those are still the right little movements that will work in my favor. I'm not going to hang around in it. If you get your 2%, go find something else. And I know that the broad sentiment is pulling in the right direction still. It's strong. It's going to weaken. At some point it will. It's been very strong since November 10th-ish. Right? It's a lot of money, global macro money, adjusted its posture. But that if something cannot last forever, it will stop. It's the Herb Stein's rule. And it will. We'll see in the data when those things are beginning to deteriorate. But all of those are probabilities that work in my favor. Bought it down. You don't have to do that. Really, the math shows that if you use a midpoint, which really is to say, whenever I decide to buy it, if the market is rising and a member of the momentum portfolio hasn't matched that yet, give you a case in point. Lyft, if you look at, or even SoFi today would be an example. But let's go look at Lyft. If the market has a little gain outside the gate and a stock in the momentum portfolio doesn't, well, mathematically, you have just as high a probability of producing a return that you would if you waited for it to go down half of its volatility. So long as broad sentiment is still very strong and supply is strongly divergent. Once those things deteriorate, then the probabilities change. But you could have very easily made your 2%. And you know now, if it's up 2.5%, and you go over here and you look at Lyft, wherever it is, here it is, and you get like 3.3%, well, it's up almost all of its daily volatility. Well, you don't want to hang around because the probability now is that it deteriorates. I'm not saying it will, but that's what tends to happen mathematically because the machines are going to lower the price. So they get, they're going to move the price up and down. Why? To prompt buying and selling by others. Why? Because that's how they make money. They make money sitting between in tenths of a penny. I looked at my trades for Chewy and Neo, and it took 50 trades. I owned several thousand shares of each. And I looked at how it got broken up, and all of them, like tenth of a penny, hundredth of a penny. Somebody was intermediating every trade. Well, that's how they make money. So all of these, my point, the reason I repeat these things is because we're not guessing at this. We know certain things to be true. I know exactly what the exchanges do to incentivize Citadel to set the bid and the offer. And how much those prices will move tells us what kind of risk Citadel is willing to take. I'm just using Citadel as an example. And we're not going to compete with them. We're going to take what they give. That's all we're doing. And we're making sure that everything is working in our favor. If there are options expiring, be careful. Earnings. There are futures and options that expire tomorrow. It's the last contract of 2023. Maybe it'll be fine. But if the market does something funny tomorrow, you will know why. And maybe that for me will be a reason not to trade tomorrow. I don't know. I'll look at the data each day and I make a game time decision about that. But these are the things that I think about all the time. But this is trading basics. I sit down, I look at it. If I can, because I like to do other things, I may buy early in the day, or like yesterday, I bought Neo at 1:59 p.m. Mountain Time, right before the market closed, because I don't want. Time is risk. The longer that you hold something, the greater the probability that something goes against you. And so I bought it because it was down, and I look at the supply-demand balance. I see it was the Hicks rule. It had just gotten to 10, and supply had fallen day over day. And so then the next day, the price was down. And so I bought it at the last minute of the day so I don't have to hold it all day or sit and watch it. So as soon as the market closed, I put stops and limits on it. And then I didn't think about it again until before before the market opened today. And I thought, well, it looks pretty good, but I took off my stop and limit. So why? Because they don't want a machine reading it. Stops and limits are hidden liquidity. They are orders existing in the market. And while they may not be visible, they can be found, they can be discovered. Right? So I don't want that. If I'm watching, I don't want the machine to come and move through my stop, right? And the only way to avoid that is put your stop so far down that the machine's not going to do it. Well, then you're risking a lot. Here's how I think about that. This was from a presentation I gave for interactive brokers. Let's say that the close for MRO, if you can hear, I'll make this a little larger so you can see it. So, Marathon Petroleum, this was back earlier in the summer. So say the previous close was 24.79, and I know that its volatility is 1.7%. So it declines all of it. It happened to decline all of its volatility to 24.37. So where would I set these things? Well, I put my limit 2.5% up from that. And I might take it off and just take 2. And I put the stop 50 basis points below that. So 24.20. What's the risk? Well, my risk is I could lose 0.5%, 50 basis points, right? My reward is I make 2.5. So that's a pretty good risk reward ratio. If I really want to, I could increase this, but of course, then the risk goes up. If I put it 75 basis points down, a lower probability of being triggered, but there's less risk reward return. So then how long? Well, with Neo, I got on the bus, went to the slope before I got, I go out skiing first track. So I got there 750. And so then I look and I'm up 3% and I sold it right there. And I'm done. So then I didn't have to, as long as I'm aware, what was my risk there? That between 730 and 750 is I'm not watching that suddenly the price plunges. But why would I think that it's probably not going to do that? Well, because I know what the math is, right? It already did that yesterday. What's the probability it does it take? Small, it's possible. But with demand strong, supply insufficient, the probability is the price rises. And sure enough, it did. Here's this probability data, and I'm getting close to being finished here, by the way. I just kind of blended the points together. This is all in Excel because this is what I do. I will mock this up and then give it to the engineers. So I said, what do I want to do? I want to find out when stocks are, see this if and up here, I want to look for demand and supply divergence, where demand is 8 or better and rising, and supply is 50% or less, below 50% and declining day over day. That's all I'm looking for. When that condition exists, then I want to know what's the midpoint price, and then what's the probability that it moves 2% in the next 1 to 5 days. Well, routinely it happens on the day of, and I just will be triggered by a sell. So then we calibrate. This was year-to-date data through November. Well, there's the probability. There's an 89% probability of making 2% when those conditions exist. Well, it's incredible, right? So that's AMD. VRT, 87%. NVIDIA, 88.9%. Coin, 88%. I forget what this is. 75%. Twilio, 83%. Square, 100%. That's why I like to trade Square. I mean, if Square has these conditions, I'm trading it because I have almost a guarantee in 1 to 5 days of making 2%. And that's what I want to do. Apple, no. Apple, 43%. Apple isn't a momentum stock. It's a 5. It's a low volatility stock. When we ran the data on Apple for 1% return, when it's at 5 with falling supply, it's 88%. But you only get 1%. Well, that's what you do when there's no momentum in the market. You cut your return expectations in half and you just take 1%. But the math's incredible. Enphase has not been a momentum stock. All year, it's back in the portfolio finally, which is not a good sign. It's a bad sign. When the junk shows up in momentum, I'm not saying Enphase is junk. I'm just saying it's not got the drivers, the excess demand that it did last year. So it's a coin flip. Well, why trade a coin flip, right? That's gambling. And we're not gambling where we want very high probabilities. Netflix, 83%. ServiceNow, 67%. That's weaker, but still good. Shop, coin flip. It's a much better trade when it's a 1. Why? I don't know. I just know that mathematically, it's not a great momentum Hicks rule trade, 10 and falling supply. Uber, 90%. Affirm, 80%. Roku, 86%. So, I just took a random set. Now we're running that everywhere, right? So could we tell you what the probability is? Well, yeah, we're working on that. So my point out of all of that is to say that is where you want to be. You want to have such high probability that you're going to produce a return that you have a lot of confidence things are going to move in your direction. The cornerstone of that is really broad sentiment. If we know that there's massive demand, this is redlining. And look, it's unusual. Generally, when the market tops the red line, wherever that occurs, so this was, what was that date? So November 10th, we rose from 5.9 to 6.6, and SPY was 440. Historically, the market has a high propensity to return to that level. Well, look where, it's almost at 480. Is it going to do that? I don't know. But I think when the market does deteriorate, there's a high probability it returns below 440. Look, I don't know what it's going to do. But this has been pulling in our direction, right? Very strong demand, plunging supply. What's the market likely to do? Rise. And that's helping us too. It helps us know that we can go trade momentum with great confidence that we're going to be successful. Okay, let me answer some questions if there are questions. And if there's a hand up, please go ahead. Just, Steve, Andrew. Steve, go first. Andrew, go second, if you would, please.
Yeah, going back to quite a ways back when you were talking
Okay.
about not wanting to run stops or limits.
Yep.
Why not limits? I understand a stop where that can swoop down and grab you, but why a limit? Because they can't just come in on a limit.
Well, they could take it through a limit, right? It will still become, or what happens, here's what I find. Can I prove this? I can't absolutely prove it. I've had these discussions with the firm, like the guy who runs Virtu, Doug Sifu. I know him, not super well, but I know him pretty well. I could trade emails with him anytime. And I had this discussion with him. They buy retail order flow. And so, what they wholesale it, they buy it and turn around and sell it. And so how is it when those limit orders, what I find is when there are limit orders in the market, prices stop rising because the machines will know, ooh, do we want to take the risk? Do we really want to buy that? What you're doing is you're ceding pricing to someone else. So I don't prefer to do it, but you're an expert, you're a veteran. So I want to, what would you do? What would you suggest? You're muted.
I run limits all the time.
Yep. And they work for you.
I have not seen them take those limits out of order or big dips and back up. It's just like when you go and you're looking on your minute chart, you're seeing that you were nothing drugged down to grab my limit.
Yeah, well, it wouldn't be just yours. It would, of course, have to be other people who end up at the same place, right, and tip the balance. So yeah.
And 90% of the time, when it takes my limit, it continues to keep going on down.
Yep. No, and it makes sense. Again, the bulk of orders in the marketplace are being set by the fastest participants in small pieces who will be wholly motivated by the supply-demand balance. So, okay, Andrew, sorry about that. I missed you guys. Andrew, go ahead, please.
Hey, Tim. Good afternoon.
Hey, good to see you.
Just a quick note on that last comment. I was going to say, I guess if you believe in technical levels and then your level is there at your limit order is there at that level, then it's hard to tell whether it's being triggered by your limit or just that's technical level that the machines are going to, right?
Right. And realizing there are, with data we track, that the market trades billions of shares, millions of times a day. The SPY alone trades roughly 1 million times a day. So yeah. I'm not saying my limit is causing it, but again, I think the first order of business is you should protect yourself. I don't want to say anything other than that. You probably agree with that, Andrew.
Oh yeah, for sure. My question was on that Excel that you pulled up. You had broad sediment in that, and I was wondering, is there a way to include that in a portfolio? Because I've been trying to include broad sediment because it's different from the S&P, right? And it'd be helpful to have that broad sentiment and the short volume to compare it when you're comparing a symbol, right? When a ticker. Do you have that, or is there a ticker you put in to get that broad sentiment number for the market?
Well, obviously we could do this with an API, and I get that, get that ask all the time. And one of the reasons we haven't done it is I've just got my hands full with this interactive brokers thing. I don't want to get that sorted out first. But we get this and we put it on the development schedule so that one could get that data from here, like download the data, because that's what I've done. I'm just, I'm using what you're looking at is this number.
How do you get that?
And there's not a way to download it currently. You can look at it. You can look at it historically, but to do what I did, of course, I'm using a database output, and I wanted to see, does it do the probabilities change at certain points? If broad market sentiment is falling, do probabilities change? Well, they just go away. So yes, we will. I can't give it to you at the moment, but we've got it on the docket, and I understand it would be very helpful.
Okay.
Yep.
Thank you.
Yep. You betcha. Bart, I think you were next, please. Or Terry. Terry, you're up. Go ahead.
Yeah. Okay. So you mentioned the Hicks rule and getting, so is 10 usually a number where you're going to enter, or would there be a number lower than that you might enter?
Yes. So the short answer is yes. I mean, it could be 7, 8 can work too, statistically.
Okay.
So long as it's rising. We just find that there's a very high probability at 10. There's a better probability at 10, but the return will be lower. Now, and I'm comfortable with that. You know, the probability of producing a 20 or 30% return, if you buy it at 8 with, you know, or 7 with falling supply, is much higher. But the probability that the risk is higher, because there's no guarantee that a stock that has demand at 7 will have demand at 10. I mean, oftentimes that doesn't happen. So we know when it gets to 10 that there is excess demand, and that's why the probability is better. Yeah.
Okay. And on the supply,
yes,
you're saying that you want to see a downtrend. Is there a certain number there too? Like, are you looking for below 50% or just a downtrend?
I prefer, and again, this is supported by the math. The math says you're better off. It's not an absolute. There's no question stocks that demand trumps supply, but supply of less than 50%, and to me, a 1 to 5 day downtrend. We use both. And those are, and you can go vet that data using a dynamic portfolio. You could go study this and say, give me a short volume 5 day trend equal to down. And then add the other criteria like at 10, days at 10, those kind of things, and vet that data. But that's what we've done. And we've found out that 1 or 5 is very telling because the market has very short-term propensities. So that's what we look for.
Okay, very cool. Thank you.
Okay, you betcha. All right, Bart, I've skipped over you. You're up if you'd like to.
Can you hear me now?
Yes, gotcha.
Yeah, actually, I had some questions about that search tool that you showed just before.
Okay.
I was wondering if you have a description somewhere, what kind of options I can fill in over here, and what's the best way to look for stocks?
Yes, there's a short. It's obviously it's not very detailed, but it will give you the basics here. Over here at Market Structure Edge, if you go over to Resources and you go to How to Use Edge, there are a series of these. Unfortunately, they're me, but you can. But here, I think it's number. Is it 5? There it is. There's using your Edge dashboard. And Edge portfolios and using Edge data to build portfolios. I couldn't remember which number it is. It's number 9. That will give you the basics. But always keep in mind that what we have done with the momentum and low volatility portfolios is do a lot of the math for you. We're saying if you want low risk, lower return, like 1%, if you're using it for short-term trading. These math bear out. If you want to, obviously I prefer momentum because you have a better chance of a return, but those have really well vetted data. They're liquid, you can get in and out of them, they're predictable, those kinds of things.
I did indeed find the momentum portfolio that had actually a good selection of stocks in it.
Okay, good. And when they run out, there's nothing wrong with the data. The data are just telling us to beware that now the risk is higher and the opportunities are fewer. Yep.
All right, thanks.
You bet. Steve, you got more? No? Okay, just checking. Okay, anybody else? So I kept you just as long. Sorry about that. If I've answered the questions, I will make this really quick to wrap up. If it, and maybe you've all, I don't even know if this is helpful to you. But a word about what may happen next. I wanted to comment briefly on this idea of breadth. That the fact that the market has broadened out, and it's not just the Magnificent Seven or whatever we're calling them now, creating gains, but it has deepened down into the market. Just be careful of that, because something we know a lot about is the way that institutional money behaves, and exchange traded funds are a core driver. And exchange traded funds are not mutual funds. They're not pooled investments. They are a substitute, and the way that they work. So Martin, I want to touch on that. That'll be my last thing. You're absolutely right to mention that. So they take collateral. I've had these lengthy discussions with the BlackRock ETF team. I think I've shared before. We did a 3-year study of ETFs. I talked to every academic group that has written papers on ETFs. They're very difficult to understand. The whole nature of the create, redeem process and the arbitrage mechanism. But I can boil it down to the basics for you. They are collateralized instruments that are meant to track stocks, and the collateral is stocks. So a broker like Morgan Stanley will bring call it $10 million worth of stocks to BlackRock. That's collateral, and it'll give BlackRock the $10 million of stocks that roughly match some. They don't have to be the mirror. They could just be whatever Morgan Stanley's got that is substantially similar, as a prospectus will say, to what the index contains. If Morgan Stanley has a lot of crap stocks available and they give it to BlackRock, what if they give you one stock? They said, we take good collateral. I said, what if they give you a check? They said, we over collateralize cash, meaning they can write it like, here's $10 million. And then they get $10 million worth of ETF shares to sell to the public. So what does BlackRock own? $10 million. Or BlackRock owns the stocks. You do not own the stocks. You own the ETF. BlackRock owns the stock. All right. So when they run out of collateral, they start going deeper into the market for collateral. If all of the apple has been consumed, then they will have to go to end phase or whatever. And then people look at that and go, oh, the market's broadening out, and that's a bullish signal. No, it's not. It means the market is running out of collateral. And then what happens? Well, then at some point, BlackRock starts to get rid of that collateral because they can do whatever they want with it. They own it. They are a money manager, and they're managing assets. So I don't look at that as a great thing. You have to understand what the money is doing. And that data is if you want to go read the SIFMA fact book, read the Investment Company Institute's annual fact book, comes out every May. We read those things and look at the trends, and they're overwhelming. I mean, it's just, this is what the money is choosing to do. Okay, so Martin, to answer your question, which is a great wrap-up point, is what to look for to know that the market is turning. Well, it's pretty simple. You back up to a year ago. Broad sentiment at the end of the year was 3.7, and supply had come down. It was like, I think it was 48%ish, about where we are now. But the demand was like this. So what was the probability that the market would rise in January? Well, nearly 100%, because we find that the market 100% of the time rises when demand drops below that green line. It may be instantly. It may be a little bit later, but it always happens. And 100% of the time, when demand falls and supply rises, the market declines. Now, it could be very briefly, or it could be steep. So that, Martin, is what we're looking for. Does demand decline and supply rise? If those things happen, the market is going to turn. And I think it could be violent, not because I have an opinion about it. It's because each time that we have had very long stretches of strong demand, when they end, they have been violent, like 1,000 points in 2 days off the Dow. I'm not saying that's going to happen, but I don't care really. I don't want my long-term holdings. We have long-term holdings that have been doing very well because we're more weighted toward bonds than equities, probably 80% bonds because it's been the place to be. Clearly, that's, and that will change, and then we'll change our tactics. But it's been very, very good for those long-term portfolios, and I don't want the market to fall apart by any stretch, but I know that that's going to end. Those are the things I'm checking each day. If this suddenly spikes and it has a 3-day, 1 day is not a trend, 2 days is not a trend, 3 days is a trend and a pattern. So, that's what I'm looking for, Martin. When that happens, it's a good time to be very careful. Then what do you trade? Trade short or trade low volatility?